Hey everybody, welcome back to Click Capital, your go-to channel for all the latest market data analysis and charts. And a bit of a quiet day here on Wall Street, heading into Good Friday tomorrow. We finished the day slightly up. NASDAQ was the winner of today, and surprisingly enough, the market held up pretty good. We did have that weaker jobs market data come into, which I'll get into a bit. But it does look like we could be forming a bit of a weak volume divergence here in most stocks. You can see this move up here in the S&P, and then the volume is just coming off. So this may be a top around here on the SP, around 41.30. We've got non-farm payrolls coming out tomorrow, but of course the market is closed. So Monday could be an interesting day as the market could be forming a little top here. We do have mid caps trading under their 50 bar along with small caps and micro caps as well. So the small end of town is very weak. It's only really mega cap tech that is really holding this market up, and a few other names. But we'll come back to the chart. Let's hop on over to the data and go through all the latest news today. So very mixed out there today in all the sectors. Energy was the only thing that had blanketed breadth. Everything else was kind of mixed. Mega cap tech actually had a good day. We saw Microsoft break out, and others like Google and Meta did well too. So we saw jobless claims actually jump a lot higher than expected. Consensus was 200,000. We came up with 228,000. 4-week average higher, and continuing jobless claims too at 1.8 million. So these signs of the jobs market getting weaker as we move more towards a recession. And this is starting to be a developing trend that we're just starting to see. So the job market has been really tight and strong for a while. And then we saw that ADP report came in weaker yesterday, and job openings as well. So non-farm payrolls tomorrow will be another big one to see if we are seeing that job market getting weaker. And once that unemployment rate goes above 4%, we're pretty much going into a recession. However, the market didn't have a big response to this data today. It was a quiet day going into holidays, so you could expect lower volumes on a day like today, but I think the big one will be how the market digests non-farm payroll that comes out tomorrow. And we're back in the greed zone here at 57 on the Fear and Greed Index. And still a lot of calls being bought out there. You've got Tesla today, 54% calls, 2.5 million contracts. AMC was massively traded with that pop today of 20%. But some other big names like Google, Amazon, Microsoft, and Meta all experiencing large call volumes, along with the AI crowd as well in C3 AI. Dark pools sitting right around neutral here, not quite bullish, not quite bearish, and they have been dipping over this past few weeks. And corporate insiders aren't buying here as well. In fact, they're increasing their sales, as I'll show you soon. So a few signs the market could be losing support from dark pools and insiders. And we're currently 50-50 whether we get a hike at the next Fed meeting or not. And an interesting chart I wanted to show you today is mega cap tech enterprise value as a percentage of GDP. Now, back in the 2000 tech bubble, when valuations got super stretched and the NASDAQ ended up coming off 80% over the next couple of years, it got to about 29% of GDP, the top 10 tech companies. In the most recent bubble we've just had, that went to well over 50%. So if you look back in market history, we've seen this, from the early days in the railroad bubbles. Whenever one sector becomes such a large part of the market, it's very rare that it stays there for too long. What we often see is that reversion to the mean. And a big reason why I think we've seen that those stocks become such a large percentage of the indices is because of the growth in passive index investing and ETFs. And this is something a lot of big investors have been commenting on for a while now, and the unknown effects it's going to have on the markets and our economy as a whole. And we can see that here with the top 5 stocks becoming such a big part of the SP500. And this last 10-15 years, because of that great run in the S&P, passive investing's just significantly outperformed active investing. But I think we could be in a bit of a passive investing bubble hidden in plain sight. And I think going forward, we will revert back to norms and valuations, and the next 10 years passive investing shouldn't be as good as the last 10 years. So I think this is fertile grounds for active investing and stock picking instead of just blindly buying the biggest stocks out there. And we are seeing some insiders sell into this. It was only a couple of weeks ago, AMD, an officer sold 1.5 million of stock. Elon Musk's brother, just a few days ago, sold almost $20 million worth of Tesla shares. And he has a pretty good track record. Like I say, the insiders often sell into these peaks. And I remember him selling the top back in November 21 at almost $410 a share. He almost nailed the exact top when he sold $108 million worth of shares. So he's selling again here, a pretty sizable clip, and we've seen that with a few others as well. Starting to see a director a few days ago, Nvidia, sold $1.3 million worth of stock. And they can often come in clusters. Insiders, whether they talk to each other or not about their stock sales, or they can see each other, they kind of get this herding effect. And you'll often see, a few weeks later, there'll be some more insiders, and they'll kind of cluster around, a month or two, all selling together. So we've just seen a sale come in on Nvidia, and I'm pretty sure the longer we stay up here, or if we even keep going higher, insiders and the CEO will just sell into it. So I'm becoming more certain by the day that we're nearing a top in Nvidia up here, if not a consolidation zone, which I'll get into on the charts in a bit. And this is the commodities to equity ratio chart. And if I was to compare our current market to something in the past, I'd say we're similar to something in late 2000, 2001, where we had that huge tech bubble in the late 90s. So tech stocks performed super well against commodities. And then it started to turn up after being depressed for many years. And I'd say we could be at a similar place where we are right now. We've had this huge underperformance in commodities for about 15 years, and that huge outperformance in SP, NASDAQ, which in my opinion hit a blow-off top in late 21. And so this is one of many reasons why I'm a strong believer in commodities going forward for many years, well into the 2030s. I'm going to stay positioned long commodities. Okay, that's it for data. Let's hop on over back to the charts. Okay, so we'll come back to the main indices at the end like we always do. Just going through the international indices here. Canada was up. FTSE had a good day, up above its 50. DAX holding up there a little bit. Nikkei flat, Aussie flat, and China came off a little bit. Volatility dives today, coming down really low here at 15 handle on the 9-day on a big contango curve. VIX at 18, getting really low here. So equity option dealers are not worried at all. Also saw bond market volatility just come off a little bit. Not many people buying puts out there, and breadth just holding steady. So a bit of a quiet day going into Easter weekend. Spreads pulled back a little bit. Growth versus value had a little bit of a bounce. Tech did well today. Gold came off. High yield had a little bit of a bounce. And surprisingly, we didn't see government bonds fall that hard. We actually put in a hammer formation on the 2-year. So we got down to 367. Actually finished the day at 383. I would have thought with that weaker jobs data, the bond market would have sold off a bit harder, pricing in an upcoming recession, because the Fed's really looking at the jobs market as the indicator whether to start, talking about pausing or not. In my opinion, Jay wants the unemployment rate to go above 4 or 5% as the only real solid way to get on top of inflation. So he's willing to sacrifice a couple of million jobs to bring down inflation for everyone else. So I guess we'll wait to non-farm payrolls tomorrow to see if we're going to see that new trend start to develop on a weaker labor market. And Fed fund futures are still holding up there compared to government bonds. We're still pricing in 4.24 on December. So they're holding up as well. But it could be the market, if we go into that stagflation kind of mode where inflation is just super sticky, even if we do see unemployment rise because of supply chain restrictions and a host of other factors. Does anyone think we're going back down to 2% inflation, the Fed's target rate, anytime soon? I wouldn't be surprised if we don't see 2% inflation for years. I think maybe in best case scenario, where at current rates around 6%, or maybe best case scenario, we can get down to 4 by Christmas. But that's still double the Fed's target rate of 2%. So maybe that'll keep bond rates higher even if we do see unemployment tick up. So I guess the most two important things to watch going forward will be that unemployment rate and the CPI inflation readings. But in either case, if rates stay up and higher unemployment, it's hard to see how that would be good for risk assets like stocks. So treasuries are held up. We actually got into a new high here today, and high yield had a nice little bounce recovery. Dollar really flat, just sitting down there in its support zone. And Bitcoin as well, sitting around here. Even though we saw Ethereum break out yesterday, pulled back a bit today. Commodities came off a little bit, just a real flat, quiet day out there. Gold sitting up at its resistance zone, and crude just consolidating but holding that gap up that we saw on Monday with OPEC announcing they're cutting 1.1 million barrels of oil supply per day against US wishes. Overvalued stocks popped back up today, ARC up 1.5%, had biotech stocks jump almost 2%, energy came off a little bit, had a little bounce here in the regionals. Still trying to find a bottom down here. And utilities just trade so strong. Look at this today. High, 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 low. So the defensive areas of the stock market have been performing a lot better. Here's consumer staples. Look at that price action, and healthcare as well. So we are definitely seeing a defensive rotation in the stock market. BlackRock, bit flat. Same with JP Morgan. Exxon came off. Tesla a little bit flat. Surprisingly, we had Microsoft break out today. Pretty good volume considering the rest of the market was really low volume. Did this huge bullish engulfing candle and took out last week's highs. And Google as well, up 3.7% on above average volume, and looks to have broken this resistance zone we've been following for a while. So I'll just go out to a weekly chart for you. You can see we've had a lot of turns around this zone here, around 105. So we're above that today. If that manages to hold, we could be looking, if that manages to hold, that may confirm here an inverse head and shoulders pattern. So this could be a bullish move for Google. We may come out and test that 120 level, which I'd say would be the next resistance around here. But this could be more of a catch-up play rather than something that's going on in the market, because Google had been underperforming for a while. If you compare it against Apple and Microsoft, have been performing a lot better this year, so maybe Google's just catching up a little bit here. Okay, back down to the daily. Meta's still holding really strong in this bit of a parabolic move up here. And Nvidia, the big one everyone's talking about. So we couldn't get much past yesterday's high today. I'll be looking for this gap to fill from the close. I'll be looking for this gap to fill from Tuesday's close. To say whether this has still got momentum. If we struggle to fill this gap, I think we could be starting to form a topping formation here in Nvidia. We have got this big divergence forming on the daily chart, and you can see momentum stalling out. So, but I don't think it'll be so clean because we've had quite the march up. So I don't think we'll just turn straight back down. What I rather think is we may have started a distribution box that we could see up to maybe 290s or even towards 300. So this could track in a box like this for maybe a month or two, and once that establishes, I'll be looking to get short at the top of the box, the top of the range, as that's what we often see after these big price moves. So we've had that markup period, then we'll be looking to get that distribution period and then the markdown. But again, we're just so valued here on Nvidia. To put it in context, last year's net income, 4.3 billion, market cap 667 billion. So to give you an idea, put it into some context, every time Nvidia increases 1% in price, so say back here when we went up 1.4%, the increase in market cap for every 1% move is 6.6 billion. So a 1% move in the stock price adds more market cap than its entire profit for last year. Another way to look at it is, say a simple example, if you had a lemonade stand that made $4.30 last year, would you pay $667 for that lemonade stand? Even if you thought profits were going to double to 8 billion. However, if 5 years ago that lemonade stand only made $4.14, so it's just grown a little bit in the last 5 years, for that lemonade stand making $4 a year, would you pay $667 for it? How long would it take to get your investment back, even if profits were growing 10, 20, 30% a year, which they haven't been? But that's the stock market for you. Maybe if it was an AI lemon stand, people would pay that. I'm not sure. Anyway, moving on. AMD off a little bit, as with Netflix. AMC bounced back. Like I said, I don't read too much into this. The whole thing's a bit of a mess. Back and forth with all types of financial engineering and rumors, anything to try and juice the stock of a dying business saddled with huge amounts of debt. And the AI stocks had a little bounce here today. So AI investors not giving up yet. And this C3 AI, I read a little bit of that short sellers report, and apparently this stock, this CEO, is notorious for jumping on the latest craze. So this stock actually initially came out, it was about 3D printing. Then they changed the name to something to do with crypto. Then they changed it again with some other fad. And then they've just changed the name and the code now recently to AI to get onto this thing. And they actually have a struggling business that loses $60 million every quarter. And apparently they've been cooking the books as well. So this thing, like I've been saying, is full of hot air, if not an outright fraud. And I would be very careful with stocks like this. Active today, Levi Strauss came off 16%. So we've got a retailer there. Came out with a slight beat, but the market did not like their guidance. Costco as well came out weak today. Costco week today as well came out and said their same store sales had dropped for the first time in 3 years. So it could be developing signs of a weaker consumer spending. And the banks had a little bit of a pop here today, coming off real depressed prices, into 4 or 3% jump on these names because they're so volatile to begin with. But we did see Wells pop up 2.7% here today, and Schwab as well hanging on. Okay, so that's a look at all the categories and markets today. Just adding that global net liquidity fair value model onto our charts here. We've got it at 3997. So that shows all our global central banks on a model, and that's been correlating really well with the market since COVID. So currently here a bit above 100 points gap between that, and that will typically close over time. So we'll just be watching the Fed balance sheet for signs of where the stock market could go. But coming up to this resistance zone in the SP, we'll just go out to a weekly chart for you. And we can see we're stalling a little bit at this new trend line I've put in here, which is also a resistance zone around this 4130. So I think we may go a little higher on Monday, but a lot's going to depend on that non-farm payrolls that comes in tomorrow. If that's weaker, if that comes in weaker than expected, I would expect the market to come off a bit as we price in a recession. But it's a little tricky here in this sideways market because we did have the weaker jobs data today and the market kind of held up a bit. So did rates, but we do have mid caps and small caps trading really weak down here. So typically they're the canary in the coal mine, and that's just a high beta play on the entire market, and they're acting really weak, and the banks are still really weak. So kind of hard to get excited about the stock market. But like I said, in this sideways market, it kind of frustrates everyone, both the bulls and the bears. And that's why I'm staying market neutral going forward. And that's all I've got for you today in this shortened trading week. I hope you have a great long Easter weekend, and we'll keep an eye on that non-farm payroll data tomorrow, and I'll make a video for you again on Monday afternoon to go through it all. Okay guys, take care, see you then.